Good morning, friends. I'm sure you're looking for a good weekend. Well, there have been good headlines in the newspapers all through the week in any case. So today I'm going to be speaking about just 4 or 5 points. The Israel-Iran war has ended. How have the markets reacted to it? And then the growth in family offices and what have they been doing right and what have they been doing wrong. The costs of studying abroad and the underperformance of PMS schemes and other stories. So let's go. So the Iran-Israel conflict ended within a few days of it began. So we've been seeing a kind of a pattern, conflicts ending very quickly. And not only conflicts, it does seem that economic cycles have also shortened. In the last few years that we see, whether it is growth cycles, recessionary cycles, wars, they seem to be ending far more quickly than one would have thought of, or what was our experience in the previous few decades. And at least as far as economic cycles go, let's keep war out of the picture, it has been very short. And this could be more because of the kind of central bank policies that are being followed, monetary policies across the world, and the kind of focus away from synchronized policy actions that used to happen, at least between the developed world and the large economies. Central banks used to be rather synchronized in their policies, on the monetary policies and economic policies, trade policies. Now we have seen all these getting fractured. And this is possibly causing shorter cycles of growth or recession. And I think we are likely to see these kind of short cycles more quickly. And yes, this does lead to more market volatility, asset price volatility, whether it is stock markets or bonds or alternatives like gold and real estate. They do tend to react quicker, either on the way up or on the way down. And one has to be really prepared to face this kind of volatility, and if you can, take advantage of the volatility too. Okay. So as soon as the conflict ended between Israel and Iran, it was a forced end, as we all know. Many of the assets quickly reversed the jump they had. The safe haven assets like gold and silver quickly reversed their flows, and gold fell almost 3.8% in INR terms and about 2.7% in dollar terms. Silver also fell 2% in rupee terms and another 1% in dollar terms. And oil fell almost 11.5%, going back to its pre-conflict price. There was this large worry that oil supplies would get constrained due to the war, and since that is out of the way, oil prices have gone back to their pre-conflict thing. And stock markets are up. Both in India and in the US, stock markets are up by almost 2.5%, reclaiming their previous highs. So there is a optimism all around. But while stock markets are showing this kind of an optimism, the one thing that is down is a dollar. The first half of the year to date, that is January to June to date as we speak, the dollar is down by almost 10%. And that is the most it has fallen in half a year since 1971. Now we try to get an idea of the kind of distrust that has developed for the dollar. Last week when we spoke, we were speaking about the dollar having gone up as a safe haven asset. There was war and no other alternative. Investors went back to the dollar. The moment the crisis was out of the way, not only that, the dollar's fall down was not only due to the crisis ending, it was also helped a lot by Trump making statements about the Fed chair. And that really unnerved bond markets and foreign currency markets. And we see the dollar has had a 1.4% fall during the week, which is a pretty steep fall for a large currency like that to have in any period of time. So nothing is like as it was before. Everything is changing and investors need to be sharp. Just imagine if the dollar is falling so much, what happens to dollar denominated assets? dollar denominator assets will in any case fall to the extent of the currencies fall. So if you had a dollar denominated asset, just because of currency fall, it has already fallen 10% this year. So those assets should have grown far more than 10% to give you a return in any other non-dollar, say in euro terms. The euro has appreciated. The euro is on a high. It continues to grow up, and seems to be a lot of investors are looking at the euro as an alternative safe haven. Though it doesn't have the kind of size that the dollar has in terms of volume, it still is attracting a lot of attention. And euro, the gold, have been hogging foreign currency reserves in different nations as compared to the predominance of dollar, which was there earlier. Okay, so let's go and see what the newspapers are saying. We go to the next slide. There is a headline in the Mint saying that family offices hit 300. So that means to say that 300 structured family offices in the country as compared to hardly 80, 85 in earlier years. And what is driving this growth in family offices? Let us remember first, family offices refer to structured investment vehicles favored by ultra high net worth families for them to better plan succession and investment strategies. So ultra high net worth families would mean that they have more than at least 250 crores of net worth. And these are the kind of families who go ahead and create structured investment vehicles to manage their investments. So while we have seen the number of wealthy families in India growing and the number of family offices going up, but what are these family offices actually doing? Apart from succession planning and legacy planning and philanthropy planning, they have also been directing their investments through these. And a number of family offices over the last few years have begun to take greater and greater risks in their investments. So apart from the standard real estate and fixed income and equity funds, a number of them have begun to gravitate towards venture capital, private equity, alternate investment funds, and cross-border investments. So the one thing that we have been seeing unravel in the US over the last few months is private equity. The illiquidity in these funds and investments is now very, very apparent. It hardly takes one small nudge to push them off the edge of the cliff. And we see that large endowments like Harvard and Columbia have been desperately trying to unload their investments in private equity, and even at substantial discounts, they are no takers. So while the West is already undergoing this problem, in India, we have not yet felt it, but it is bound to happen. This kind of risk is always there, and many family office investors are unaware of this. They get taken in by the hype of investment bankers and merchant bankers and wealth managers and go ahead and lock up large sums of money in private equity assets and alternate investment funds. So liquidity is something that they really have to watch out for. Then there's a very interesting table here, and it refers to the costs of studying abroad. The headline says, planning undergrad abroad, you should look beyond US. So there's a table which gives the costs of STEM education and non-STEM education across different countries: the US, Singapore, UK, Australia, New Zealand, and Germany. I think it's a very useful table which gives the tuition fees and living expenses and hence the total program cost. Also another interesting statistic: what is the possibility of earning something as you study through internships and part-time jobs, etc. So you can have an idea of what is your net expenditure to be incurred. Okay, no surprises, the US is the most expensive place to study. It costs almost more than $200,000, $216,000 for a STEM course, a 4-year STEM course. And at the bottom of the league table is Germany with only $37,500 for a 3-year program, either in STEM or in non-STEM programs. So this is the range that you have, and go figure where you want to send your children to study. But as far as I'm concerned, if one is planning to send children abroad to study in different countries, there is the impact of currency depreciation when you're doing your financial planning. You are, of course, going to be doing your systematic investment plan. So, two factors that you need to be looking at when you do your investment planning: currency depreciation and local inflation. So, when you're looking at this, you're not looking at India inflation. You have to be looking at inflation in the education inflation in the US or education inflation in the UK, and the relative currency depreciation between the dollar and the rupee, or the pound sterling and the rupee, or the euro and the rupee. So these are the two factors that you need to be adding into your investment plan if you're looking to send your children abroad. Please don't forget these two. And just like in India, where education inflation is far higher than CPI, even in these countries, education inflation is higher than the normal inflation, consumer inflation. So be sure to factor this into your financial plan. And then we go on to the next paper, which is Friday, and we have an article here in the Mint written by Dhirendra Kumar, and he says, why premium portfolio managers are failing to justify their fees. So there has been a furor in social media and in Twitter, to be precise, where investors have come out and stated instances as where they have invested in PMS schemes for long periods of time and hardly have come out with 6 or 7% rate of return after fees. So this does seem horrible. We all know what markets have done in the last few years, and definitely there are a number of PMS managers who have been underperforming the benchmarks and the markets. Very few investors have the ability to measure this. So when we look at client portfolios, and we have been seeing their track record of investing in PMS and AIFs outside, we are able to see that there are many underperformers. And I only wish that investors had a greater degree of awareness as to how to measure performance, measure their investment performance, and be able to take out underperformers. So that's what Dhirendra Kumar is saying here, that there are a number of PMS managers who have been underperforming, and in spite of the underperformance, have been taking back hefty portfolio management fees of the order of 2% or so. So the investors are cribbing while their portfolios are underperforming. Portfolio managers continue to take hefty fees back. So I do think you need to look at it. There's another crib about PMS as versus mutual funds. So when portfolio managers are selling, they're selling on behalf of you, or so they're regularly, when they're trading, they are booking gains, and these turn out to be short-term capital gains or long-term capital gains, and you have to be paying the tax in the year when the trade was done. Unlike in the case of a mutual fund, where the manager's trades and the impact of those trades are not felt by you, because the mutual fund does not have to pay tax. So whatever gains are incurred by the fund manager in a mutual fund do not impact your long-term capital gains tax or short-term capital gains tax. You have to pay tax on a mutual fund investment only when you sell your units. So that's a great advantage MFs have over PMS services, which Dhirendra Kumar is highlighting in his article. Strangely, in the same day in the Business Standard, we have an article by Amit Tandon, and the headline is India's Mutual Fund Paradox. Okay? So he says, while the mutual fund AUM has gone up to almost 65 trillion rupees, massive jump. We never thought that we'd be having so much jumps. But the same issue, underperformance. So he says that at least in the case of large cap funds, as of March 2025, only 38.6% of equity mutual funds managed to beat their respective benchmarks, with large cap funds showing the highest rate of outperformance at 71% for that month, while small cap funds significantly lagged at just 10%. And over longer periods, you will find that hardly 1/3 of the funds managed to beat their benchmarks. Okay, actively managed funds. and the number of funds that are repeating their performance is very few. So if you were to look back 3 years or 5 years, looked at who are the number one performer, you will hardly find any of these names repeating in today's league tables. So it just means that the number one performer keeps changing, and it is not really the way to choose your fund. But if one were to look at risk adjusted returns, the record becomes much better. So investors should be learning to look at risk adjusted returns as a means of selecting their funds, and it improves the chance of being in the better consistent fund. Okay. And also we observed that actually, at least in the large cap space, and you're looking at risk adjusted returns, the Nifty 100, which is a benchmark for most of the large cap funds, has done pretty well on a RAR basis. 14 out of 20 instances, they are in the top two quartiles and never in the bottom quartile, which just goes to show that it is becoming harder to beat the benchmark for an active fund manager. And you'll find very few who are able to actually beat the benchmark consistently, continuously. And you need to be able to track closely to be able to do this. The job for a do-it-yourself investor is just becoming harder, is what I would say. Okay, so that brings me to the end of my weekly wrap, folks. Hope you found it useful. Thank you.